If I do it with the other.
Hey guys, it's John at ListMe again, and ListMe Realty. And today I'm recording another video to kind of explain and go into depth about your credit and how you can build it to make that first home purchase. So I want to go into a little more detail about this, right? So first and foremost, you have to print it out. You have to know your credit score. You have to review all of this information and go over everything to prepare to apply for your home loan. It's important to review your credit report well ahead of this. That way you can be, an extra step ahead, right? So checking your credit reports, knowledge is power, right? Reviewing your credit report is the first step to finding any information that's negatively impacting your credit score. So run it with the three major bureaus and the information to understand and manage your credit, right? With this knowledge, you can figure out the next step and boost and maintain your credit before you apply for a home loan. So monitoring your credit score. Your credit score is an important part of your credit report, right? Without that, you can't get approved for a home loan. So this 3-digit number is key to your lender's decision and helps determine the interest rate offer you'll receive. If your score is lower than you would like, be sure to thoroughly review and review the analysis included in your report. This information provides insight into how you can start working towards a higher score. These are the 5 main categories that determine your credit score according to your FICO. So payment history is 35%. Amounts owed is 30%. Length of credit history is 15%. New credit is 10%, and types of credit is 10%, right? So they want to see your credit diversified, meaning don't just have all credit cards, have a car loan, a credit card, maybe a student loan or something like that. So just make sure you diversify. Pay off delinquent accounts. Payment history represents the greatest percentage of your credit score, which is 35%. If you have any delinquent accounts, bring them current or paying them off before submitting a mortgage application can make the difference between the approval and denial. So delinquencies include any past due payments, charge-offs, collections, or judgments that may be in your report. The delinquent-free report lets mortgage lenders know you're a responsible borrower. So making payments on time. When you're reviewing your application, lenders will look consistently at your financial behaviors, right? They want to see you making payments on time. They don't want to see you late on anything, right? So they want to see a pattern of good payment history. So every payment you make on time is extremely important. If they see any late payment histories like that, it just increases your chances of getting denied, right? And by doing this, it's a step towards improving your credit history and brings you a little bit closer to buying your dream home. So with multiple months of consistent payments, it will help the delinquency and it becomes less damaging to your credit report. So keep in mind, they won't disappear that quickly, okay? Delinquencies can remain on your credit report for up to 7 years. Bankruptcies typically stay on your credit for 7 years, and inquiries appear on your, whether it's soft or hard, I believe, appear on your credit report for 2 years. So avoid new debt. Because those inquiries are going to affect your credit report, it's a good idea to avoid applying for new loans when you're trying to improve your score. Additionally, new debt often raises red flags to lenders. They interpret it as a sign of financial instability and possible lack of responsibility. Establish long-term credit, meaning if you have credit cards that are 10 years old or something like that, don't close them, keep them open, because it only increases your average amount of credit history. Keeping low balances. Your debt to income ratio, your DTI, is the percentage of your monthly income that goes towards paying off debts. If you make $10,000 in pre-tax income a month and owe $4,000 in monthly payments towards outstanding loans, your DTI is 40%. 40% of your income goes towards paying off that debt. Mortgage lenders prefer the DTI ratios to be lower. This shows you're more likely to be able to afford your monthly loan payments. In addition to your current DTI, lenders also look at how a home loan could affect your ratio. Once approved, a home loan should not increase your DTI to an unnecessarily high ratio. This rule of thumb helps them keep track of your personal finances and make sure everything's under control. It's a good way for lenders to ensure you can keep up with your monthly payments as well. Pay down your balances to the greatest extent as possible. You want to treat all your debt as a monthly bill, so paying it off, revolving loans, paying off everything as much as you can is going to be the single greatest factor to getting your payments lower. Keeping your accounts open. While it's tempting to close the old accounts, it's not typically recommended because, like I said, this just increases your I've got distracted. This just increases the average amount of your credit history, right? Closing your accounts lowers your total amount of available credit and increases the percentage of credit in use. So let me repeat that again. Closing accounts lowers your total amount of available credit and increases the percentage of your credit in use. A higher credit utilization ratio can also have a negative impact on your score. Lenders prefer lower utilization ratios because it shows financial stability and self-discipline. Borrowers who have credit available but don't use it all or pay it off every month appear credible to lenders, okay? So know how much you can afford to borrow. When you have a monthly budget, it's easy to know exactly how much you can afford to pay off every month by understanding your personal finances and being in control of your cash flow. That's essential when taking out a loan, right? It helps you to avoid getting in debt that you can't pay off, which could potentially harm your credit. So with that being said, you know, building credit takes time. This isn't going to happen overnight. So if you're in the market or you plan on being in the market anytime soon, you need to get ahead of this. You know, it's a gradual process. It takes time for the negative information to disappear from your credit report. There's a number of steps you can take now. So let's work towards your goal of getting all the negative stuff removed from your credit. And as always, let us know if you have any questions, DM us. Or put it in the comments section, and we'll get back to you usually within minutes. Elizabeth and I are really good at that. So let us know. Either one of us can help you. And you guys have a good day. Thank you.